All right, well, welcome everyone. This is the first live chat for our investments and portfolio management class. So as I said earlier, I hope everyone had a wonderful Memorial Day. And I know oftentimes we have people that have or are currently serving in the armed forces. So if you're one of those, thank you so much for everything that you've done and the sacrifice that you made. So with that said, you're going to notice that I follow a format every week. And so we're going to use that format today. And really what the hope is that this will help you stay on track and keep up with all of the deliverables that are due from week to week. So what will normally happen during a week chat is we'll start off with 1-minute surveys. So this week we're going to replace that with brief introductions to one another. Then I will go over the upcoming items, important dates, and so forth for this class, largely drawn from the syllabus. So today we're going to talk about the high-level items from the syllabus, but it gives us an opportunity to make sure that we're all on the same page with regard to the requirements for the upcoming week. And then the second half of the class, which really tends to be about 80 to 90% of the class, is where I am going to dive into the key points from the assigned readings and articles and so forth. And I'll touch on this again later, but just know there is no possible way that we can cover everything that you're expected to learn during the week in an hour-and-a-half chat. In fact, we could probably hold class 8 hours a day, 5 days a week, and not get through everything. And so one of the big points of a class like this is that you take the time to go through the pre-recorded lectures, to read through the articles, to read through your textbook, and to come prepared with any questions. And then I'm also going to identify areas that I think are most pertinent for your understanding. But just know that there's, once again, no possible way that we can cover all the material. So that is not the point of this class, to teach you everything. And so that'll be important for you to keep in mind as you go through the quizzes and other assignments, because you'll notice not everything was touched upon. Although, once again, I will try to cover the most critical and the most difficult to comprehend subjects. So with that said, let me go ahead and start off with an introduction about myself, and then we'll go through each of you. Really, this introduction should last about a minute, so try to really keep it short and concise as we go through it. But my background, so I do have a bachelor's degree in accounting from the University of Arizona. I earned my MBA from California Lutheran University, so like most, if not all of you. I do have the CFA charter, and also I am a CFP certificant. So I earned the CFA charter as I was going through, or I should say, as I just completed the MBA, and then I earned my CFP certification after I completed my CFA charter. I worked previously at Gould Asset Management as a portfolio manager, and I currently am a partner at Polaris Greystone Financial Group. So I specifically spearhead the business development for the company. And then my personal life, I live in Anaheim Hills. So if you're not familiar, that's in Orange County, very close to Disneyland. I'm married. I have a 4-year-old son. He's actually 4 now. At the time I wrote this, he was nearly 4. And when I do have free time, which seems to be very fleeting these days, I like to play basketball and play softball. So with that said, Eric, we'll go ahead and start with you. And if you wouldn't mind just sharing with everyone how far along you are in the program, what you're currently doing for your career, and then if that's not what you'd like to do or what you want to do, share with us what you'd like to do.
Yeah, so I am Eric from my office. But I've had classes with, I think, every single one of you at this point. But I work at TD Ameritrade. I'm a senior financial consultant. I work out of Bellevue, Washington, which is 15 minutes east of Seattle, Washington. I went to school at Purdue University, where I studied business management. Where I want to go is basically to get a CFP, get my MBA, and probably work here for a couple more years, but maybe work for become a wealth advisor for an independent RIA, or eventually go into corporate finance.
All right, perfect. Well, it's great to have you, Eric. And you probably know my wife, Melissa, who also works for TD Ameritrade. Melissa Whitbeck.
Yes, Melissa was my guide sales manager.
Oh, yeah. Oh, great. So perfect. So I've learned that the finance world is a very small place.
Yep.
So, all right. Well, thanks so much for that introduction, Eric. And then Josh, if you wouldn't mind going.
All right, good evening, everyone. My name's Josh, and I'm in my second to last term at CLU. I graduate in October, and then I'll sit for the CFP exam in November. I'm currently an English as a second language instructor online, and that's what I'm doing as I work my way through school. And afterwards, obviously, I'm sitting for the CFP exam, so I'm trying to find any way into the industry and then just gain some experience and go from there.
All right, well, perfect. Well, good luck on the CFP certification. When do you sit for the exam?
I don't know the exact date, but it's in November.
Okay. All right. Well, you have a treat ahead of you as you study for that. But if there's anything I can do to help out, let me know. I took it actually before the new format, but there are definitely things that I had identified that I think were more effective. So I'm more than happy to share on the side if you're interested.
Yeah, great.
All right, Andrew.
Hey, Andrew Marks. I also had classes with, I think, the majority of people here, so it's great to see everybody again. I graduated from Stevens Institute in Hoboken, New Jersey, a number of years ago. Spent a decade with JP Morgan as a financial advisor, where I kind of built my book of business, and recently left. So about 8 or 9 months ago now, went independent. I live in the Hollywood Hills in Los Angeles, married. I have 2 children, a 2.5-year-old and a 3-month-old. And yeah, I'm kind of an outdoor active guy, so really into triathlons, biking, cycling, swimming, those types of things.
All right. Well, it's good to have you, Andrew. You said you live in the Hollywood Hills area. Which part exactly?
So if you're familiar with like where Mulholland is and with Roll,
Yeah.
right behind the Hollywood Wall.
Yeah, absolutely.
Yeah, right there.
Okay. Yeah. So it feels like a lifetime ago, but previously I lived in the Los Feliz area.
Oh, sure. Right on the other side of the highway.
Exactly. Yeah, not far from there at all. So it's a very cool area, a lot to do, but also it's always busy. It's always booming.
Yeah.
So perfect. Well, it's great to have you, Andrew.
Thanks.
And then Chrislyn, if you wouldn't mind giving us an intro real quick.
Hello. Can you guys hear me?
Yeah, loud and clear.
Oh, okay. Yeah. So my name is Chrislyn Barbas. I recently graduated back in 2016 from Channel Islands, California State University of Channel Islands. I got a BA in economics, and I'm right now just doing the MBA in financial planning. I'm 3 classes away from graduating. So far so good. I mean, I had learned a lot about estate planning and all the other classes. What else? Work experience in the financial industry. I haven't get any. I don't have any experience. I mean, I have worked with in the military as a financial advisor for my troops. Other than that, I mean, my own financial background. I mean, getting out from there, being financially stable. As of right now, I mean, I have few interviews. I'm still applying for jobs, but nothing yet, no luck. What else? I live in Goleta, California. I'm married. I had three sons, all boys, yeah. And I do a lot of walking by the beach and take my kids to the playground and do sports with them. And that's about it.
All right, awesome. What branch of the military?
I was in the U.S. Navy.
All right. And then, do you prefer Chris or Chrislyn?
Chris is fine.
Okay. All right, perfect. Well, it's great to have you, Chris. I think, did we leave off at Giovanni?
Yeah, so my name is Giovanni. I graduated from a school. I'm up in the Northeast. I'm in Albany, New York. I graduated from a school out here, Siena College. Started this program back in October. So this is my 4th term, I believe now. So I have 4 of the CFP classes done and 2 of the MBA. So planning on sitting for the CFP this coming November. And then I should be done with my MBA right around the July timeframe of 2019. And in my free time, I work at this isn't my free time at all, but I work at this company called ACO. We're a Goldman Sachs company. I'm a financial planner up here. And really in my free time, I really like to play a lot of golf. So.
Yeah, that's not too shabby, playing golf. I think the last time I played was about a year and a half ago, so I'm probably going to
Very
nice. Myself next time I go play. So, all right, Jennifer.
Hi, everybody. Can you hear me?
Yeah, you're coming in a little quiet, but we can hear you.
Yeah, it's probably my computer. But anyhow, so yeah, I have been in the program. This is actually only my 3rd class, so I have a little ways to go. Enjoying it so far. I've been in the industry for about 11 years. I'm a wealth advisor planner for a local RIA in Thousand Oaks. I've been on the advising side for about 4 years. Before that, I was on the support and operational end. Hopefully sitting for my exam next July. That's what I'm shooting for. And on the personal side, I hike. Actually, Eric, I'm going to be running a marathon the weekend after our final near you in North Bend. So I have had a couple classes with a few of these guys, so I'm looking forward to this class.
All right, well, it's great to have you. I'm looking forward to the insights that you can share with everyone since you've been in the industry for a while. You said that it's been 4 years that you've been with your current RIA firm?
Correct.
Okay, awesome. Well, it's great to have you, Jennifer.
Thank you.
Last, we'll go ahead and end with Pete.
Hello, good evening, everyone. Yeah, I recognize some names out there. It's good to see. This is my 5th class with CLU. I'm kind of an outlier. I actually work for the fire department, and I've been doing that for about 13 years. My undergraduate degree was in city planning, which I did for almost a decade prior to joining the fire department. I don't have any experience with the finance side outside of these classes and just personal interest. But personal interest has gotten me quite a ways in terms of helping other people. But my main reason for pursuing this curriculum is just to help out some fellow coworkers, maybe branch out a little bit, but really specific here to Washington State for the most part. And but I don't really plan on leaving the fire department. And other than that, I've got a wife and 2 kids that I chase around all the time, coaching soccer, etc., and stay pretty busy with that. So looking forward to this class.
Yeah, it's great to have you, Pete. How old are your kids?
They are 8 and 10.
All right. I'm sure you are running around a lot then. Well, it's great to have you, Pete. So looking forward to it. So with that said, the one thing I would stress is that if anyone in here did something along the lines of what you're wanting to do and you're not currently in that area now, what I would really encourage is that you reach out to that person. What I've often found is that sometimes the best opportunities are people that you'll meet in the program, and just a friendly hello and chatting about what they do can sometimes open doors. So definitely take the opportunity to do that, especially if they're in an area that you see yourself wanting to transition into. So with that said, let's go ahead and jump into the syllabus and the upcoming expectations. So one thing I'd always stress, and very rarely do people actually take me up on it, is make sure to read and understand what's laid out in the syllabus. So the syllabus is a contract that is between me and all of you, where it lays out exactly what is going to be required in the course. And so if you follow the outline in the syllabus, you won't go wrong. So in the syllabus, it does mention we do have a required book. So that's the 11th edition of the investments textbook written by Bodie, Kane, and Marcus. So if you don't already have that book, you'll want to make sure to get that book as soon as possible, because a lot of the material is only covered in the textbook and isn't covered elsewhere, just due to time, as I was mentioning at the beginning of class. Each week there's going to be certain deliverables. So in weeks 1 through 3 and 5 through 7, there are weekly quizzes. So these quizzes are not timed. You can take as long on them as you would like. They're open book. And so really the intent is that it will help you to master the material and help you to focus your energy on the most relevant parts of the course. So please, if you haven't already, I highly encourage you to actually go in, print it out, have it in front of you as we go into the weekly live chat, because a lot of the questions will be answered either directly or indirectly. That will help you on that quiz. So you're also going to be graded on your weekly participation. So if you are if you're able to attend class and to discuss just like you all have done so far, you will get full participation. If, however, you are unable to participate in the live chat because of a conflict or whatever it may be, make sure that you view the archive and then post to the discussion board under the archive chat section for that particular week. And that will then enable me to give you full participation points. So it's critical, though, if you're not able to attend the live lecture, that you go and do the makeup chat session, or else you're going to miss out on the participation points. And these are easy points. So these are ones that you don't ever want to miss out on, because they'll really help bolster your grade. And there are weekly discussion board assignments. So there's one for this week. Typically, the way that it's structured is that you are going to read an article, you're going to post a summary, and then you're going to respond to your fellow classmates. So I request that you respond to at least 2 of your classmates. You're certainly welcome to respond to more of your classmates if you see fit. But in order to have a healthy dialogue and discussion, it's really important that you at least respond to 2 of your fellow classmates. And so let me stress this. If you don't respond to 2 of your fellow classmates, I can't give you full discussion board participation. So make sure that you go in there, that you read each other's comments, and that you add a meaningful dialogue to their write-ups. Now, if you say, I completely agree or something like that, that doesn't count. That doesn't add to the discussion. But if you do that, then you should be able to get 100% on all of your weekly participation scores, which will really, once again, help when it comes to the final grade that you get in the class. There is a project for this class. You're going to get a lot more of the details in week 3. Also in week 3, I will assign the teams. So based on the number of students right now, we have 11. So it's probably going to be 2 teams of 4 and 1 team of 3. But we'll see. If we get another student that jumps in or jumps out, it may change a little bit. And then I see a comment, is the weekly survey required for participation points? So there is an anonymous survey at the end of the week. That is not required. It is completely optional. I will address anything that's raised in the weekly survey during class, at the beginning of class. So if there's anything that you'd like me to discuss, feel free to raise it there, but it is not a requirement that you complete it every week. And then you'll notice when I talked about the weekly quizzes, I skipped weeks 4 and 8. And the reason for that is because on weeks 4 and 8, we don't have an open book untimed weekly exam, but rather we have our midterm in week 8 and our final exam in our midterm in week 4 rather, and a final exam in week 8. These are timed exams, and once you start them, you have to sit and finish them. And so make sure that you do not assess the midterm until you're ready to complete it. So you'll notice I've unlocked weeks 1 through 3. I purposefully have left week 4 locked, and that's to help prevent anyone from accidentally going into the week 4 midterm and trying to complete it. Because once again, once you start it, you're on your own, and it would be way too early for you to try to do that now. And so if you get to where you'd like me to unlock week 4 before I actually unlock it, let me know, and I'm more than willing to. But I try to help out. It seems like every now and again I have someone that accesses the midterm before they're ready and then bombs the exam because they didn't need to. So I really try to help protect you from accidentally doing that. And then once again, on the weekly quizzes though, let me stress, take your time. You should start them early in the week. You have the whole week to do them. And so the intent is that you should be able to do extremely well in the weekly quizzes. So any questions with regard to the syllabus or the course expectations before we move on? No? Okay. Looks like we're all on the same page. So this is just going over the midterm and the final exam. Once again, the 1-minute surveys are optional. They're completely anonymous. So I don't know who completes them or who doesn't. So feel free to raise any questions or items that you'd like on the surveys, and I will cover them during the beginning of the chat. So obviously week 2 would be the first week I'd cover the week 1 surveys that were submitted. So with that said then, I'm going to go ahead and jump into the material unless there's any other questions that you have about anything that we've gone over so far or anything with regard to the course structure. No? Okay. All right. Well, as we go through this, you'll notice that there's a lot of different ways that you can aggregate the different asset classes that are available. The way that the book does it, and is actually quite fitting, is it breaks everything into money market instruments and then capital market instruments. So we'll go ahead and follow that format for this week's chat. So a money market instrument is something that is very short term. It's highly liquid. It tends to have very little, if any, risk. And there are things that we're probably quite familiar with. So for example, if you've ever invested in a CD at a bank, which is also called a time deposit, that is a type of money market instrument. Also, if you've ever had your money in a money market fund or money market mutual fund, that is also a money market instrument. T-bills would also be included. So T-bills are treasuries that have a maturity typically less than 30 days. Commercial paper, which you may or may not be familiar with. Commercial paper is the corporate equivalent of a T-bill, meaning that it is very short-term credit lended to a corporation, and these are very high credit quality corporations. And so all of these are examples of money market instruments that are very short-term, have very little volatility risk, and as such tend to give very low returns, especially in our low yielding environment today. There are also capital market instruments. And for most of you, I'm guessing that this is what you think of when you hear the word investments and portfolio management. Capital market instruments include things like bonds, equities, so stocks or REITs are equity investments, and then also derivatives are included in the capital market category. So we'll learn a lot about derivatives in a future week's lecture, but derivatives are assets that derive their value from a different asset, hence the name derivative. So for example, call options derive their value from the movement of the underlying stock. So for example, if I had a call option on Apple, that call option would derive its value from the movement of the Apple stock, where the call option participates in the upside potential of the stock. And so all of these are capital market instruments that typically are much longer term in maturity length, much riskier, but also tend to give us much better long-term rates of return. So I'm going to go ahead and jump through some of these capital market instruments in greater detail. And so the first one that we're going to go through are some of the bonds. And so to start off with, we'll talk about some of the federal government treasuries that are available for investing. So within the federal bond space, within the treasury space, there are T-notes and T-bonds. So you recall that T-bills were included in the short-term money market instrument. So T-notes and T-bonds have maturities that range from up to 10 years, whereas T-bonds can have maturities all the way up to 30 years, so much longer term than what a T-bill is. Treasuries are typically denoted in par values that go in ranges of, or I should say increments of 1,000. So for example, if you wanted to buy $10,000 worth of T-notes, you'd buy 10 treasury instruments for a notional value of 10,000. The interest on a T-note and a T-bond is paid semi-annually, so it's paid twice a year. Once after the 6 months after the maturity and once 12 months after the maturity, and then it continues to cycle until the bond matures. And typically when we quote a T-note or a T-bond, it's quoted as a percentage of par. So for example, if you're buying a bond at par, which means that the coupon rate is equal to the market rate, you would pay 100% of par. If you're buying a bond that pays a higher coupon than what the market gives, so for example, if you're buying a 5% treasury in today's 3%, we'll call it market environment, right? We would expect to pay more for that bond since it's paying a higher interest rate than what you can currently achieve. So you might pay something like 115% of par or 110 or whatever the math dictates. And then if we're buying a bond that pays a coupon rate lower than the market rate, we're going to get a discount on that bond. So if I buy a 2% treasury, I will probably pay something like 90 or 95% of par, since it's paying under the 3% rate that's being paid out on a 30-year. I think the 10 years dropped to about 2.7, 2.8. But that's how T-notes and T-bonds work. And once again, they're a type of capital market instrument in the bond space. So we also have other types of bonds. So another example that has been gaining popularity lately are TIPS. So TIPS are a special type of debt that is indexed to inflation. So the whole purpose of a TIP is to protect you against unforeseen or unplanned inflation. And so for example, right now inflation is hovering somewhere around 2%. And so if you were to go out and buy, say, a 4% bond, that would mean that you're getting a real return of about 2%. But what happens if inflation starts to accelerate and the 2% inflation that we know today goes away and it's replaced by 4%? Well, in essence, that 4% bond is no longer giving you a real rate of return, meaning a return above what inflation is, and you are just treading water at that point. And so a TIP is an attempt to eliminate that risk. And so the way that a TIP works is that the notional value of that bond is going to be restated or adjusted rather as inflation moves. So for example, if inflation increases, or I should say if inflation causes the cost of goods to increase by 2% next year, a TIP would also increase its nominal value or notional value by 2% so that the value of that bond stayed current and relevant. Now TIPs work both ways. If you go through a deflationary period, the TIP will also restate its value downward, but it won't go any lower than what the nominal value of that bond was. So if you paid, or if it had a par value rather of $1,000, you'll always at least get your $1,000 back. There's also federal agency debt. So this is debt related to things like mortgage-backed securities. So when you buy a conforming loan, what happens is those mortgages are pulled together and then sold. And so when you're buying debt from Fannie Mae or Freddie Mac, that's what you're buying. And then we also have local government debt or state debt, which is called a muni or a municipal debt. The special thing about a muni is that the interest is exempt from both federal tax and also potentially state and local tax, whereas a federal bond is only exempt on the state level. And so since munis are tax exempt or tax free on both the federal and also the state and local level, it can be very attractive to high income tax bracket buyers since they don't have to pay taxes on the proceeds. And so as such, you will often see that munis pay a lower rate of interest since they know that their interest is not going to be taxed. Now, it's important to note that if you buy a, say, a Colorado bond and live in California, it's not likely, in fact, in this case, it would not be a tax-free bond. And so in order to enjoy the tax-free benefit, you typically have to buy the state that you live in, with few exceptions. So for example, Puerto Rican bonds were actually tax exempt across all the states, which is why so many people had their debt. Obviously that went bad. The Puerto Rican debt is fighting off bankruptcy, but so you want to pay attention to the type of muni bond that you have to ensure that it's going to be tax-free on the state and local level that you're in. There are two types of municipal bonds. There are general obligation or GO bonds, and then there are also revenue bonds. General obligation bonds are backed by the general tax power taxing power of the issuer. So for example, when you pay a California state income tax, that's going to help to pay back and pay the interest on the general obligation bonds that California has issued. There are also revenue bonds. Revenue bonds are tied to a specific project. So for example, if you buy a revenue bond tied to a stadium, the stadium is going to pay the interest and then repay the bonds back by the proceeds that are generated from ticket sales. So most of the time, general obligation bonds are tax-free, if not almost always. Revenue bonds, however, may or may not be. And so you want to be really careful when you buy a revenue bond to ensure that it's tax-free on the state and local level. Because once again, some revenue bonds are not tax-free on the state and local level. So any questions about treasuries or these other government types of debt before we continue? All right, hopefully this is a review for most of you. You're going to notice that this week's the only week we're really going to get a review like this. After this, we're going to really start cranking up the speed. With bonds, there are corporate bonds. So those are bonds that are issued by the companies that we do business with every day. So for example, Apple recently issued debt. You're wondering why would Apple, when they're sitting on a cash hoard, issue debt? It's because they wanted to lock in the insanely low interest rates on their debt. They knew that they wouldn't be able to get capital that cheap again, so they actually issued debt. There are international bonds. So international bonds are either bonds on international companies, or you can also buy international government bond. What's important to note about that is that when you buy an international bond, not only are you subject to credit risk, but also you're subject to currency risk. So for example, if your bond makes money, but the currency devalues, you could still lose money because when you bring the money back home to your home currency, it's not worth as much. And then we already talked about mortgages and mortgage-backed securities. Typically, those are structured through Fannie Mae and Freddie Mac, although you can buy non-conforming loans from other agencies as well. And so given all the bonds that we just talked about, what type of bond would you guess has the lowest interest rate? So this goes hand in hand with which type of bond you think has the lowest amount of risk.
Treasuries.
All right, treasuries, so T-notes, right? Why are treasuries the lowest interest rate?
Low risk.
Lowest risk. This is sometimes surprising. You might expect munis to have the lowest interest rate since they are tax-free on both the federal and state level, but you're going to find treasuries actually have the lowest interest rate. And the reason for that is because even though munis are tax-free on both levels, they have much more risk. And so the lower risk on the treasury actually wins out. And so as I mentioned earlier, a 10-year treasury, I believe, is at 2.7, 2.8%. A 30-year treasury is at 3%. So given that inflation is hovering just above 2, and let's say that you buy a 10-year note at 2.7, means that you're getting a real return of 0.7. That is an abysmal return, especially when you think about locking that in for the next 10 years. Why are people still willing to purchase a treasury if they're not even getting 1% in interest? What do you think?
They just really take risk in them.
You're exactly right. They are not willing to take the risk of the market. They need something very safe and secure, and they want something that's a little bit higher than what you can get in a money market instrument or a CD for that matter. And so because of that, they're willing to forego the higher return because they want that certainty. And so this is just a summary of the answers, but T-bills have the lowest risk because they are perceived to have zero risk. And if we want to be more technical, since T-bill is not technically a bond, then we'd say a T-note or a T-bond. And so when we look between the different bonds, it's important to note that since some bonds are tax-free and other bonds that are taxable, you can't just simply compare the coupon rate in order to determine which bond is better. So for example, if you had the choice between a corporate, which is fully taxed on both the federal and state level that pays 4%, and you have the choice between that and a muni, which this muni is tax-free on both the federal and state level, and this muni pays 3%, which one should you choose, the 4% or the 3%? And the answer isn't as easy as you might think because it is dependent upon your tax rate. And so when we compare bonds, especially when we compare different types of bonds, it's important that we look at it on an after-tax basis. And so we can actually calculate the after-tax equivalent return for a bond. All that we have to do to calculate this is we take the coupon rate and we multiply that by 1 minus the marginal tax rate. And so, for example, we're going to go through a practice problem and really highlight how the tax rate will determine which bond is more favorable. And so let's say that we have the choice between a 3% muni and a 4.2% corporate bond. And we're in the 28% tax bracket. And this one is a trick question. What is my after-tax equivalent return on the 3% muni? Who wants to venture an answer?
3%.
Yeah, exactly. It's 3%. Why? Because the tax rate on a muni is 0. So I mentioned earlier that it's tax-free on both the federal and state. So you can just take the coupon rate at face value. So the 4.2% corporate rate, unfortunately, requires a little bit more work. If we're in a 28% tax bracket, and let's say that we're in Nevada, so we don't have to worry about state income tax. What is my after-tax equivalent return?
3.02.
Okay, 3.02. Right, so which one would I prefer, the muni or the corporate?
Corporate.
Right, the corporate, because it's giving me an additional 2 basis points. Now, 2 basis points probably doesn't sound like a lot, but if you multiply that by, say, a couple $1 million or tens of millions, if it's for a big institutional fund, it starts to add up. So in this case, if you're in the 28% tax bracket, you're better off buying the corporate. Now, if your tax bracket jumped up to 30%, which bond would you prefer, the muni or the corporate? So what is the after-tax equivalent return if you're in the 30% bracket?
2.94.
All right, 2.94. So obviously that is less attractive than the muni, and so when you're in the 30% tax bracket, you actually start to move more towards municipal bonds. And so I chose this example and these rates because it really highlights the way that the market works in the real world. Only people that are in the highest tax brackets actually benefit by holding munis. What always baffles me is that you will find retirees that don't have a lot of income that are in some of the lowest tax brackets and they buy muni bonds in their portfolio. And when asked why, it's because they don't want to pay any taxes to Uncle Sam. What they're not realizing is that they would be better off getting the higher coupon rate on a corporate, paying the taxes, because they'd have a lot more left over than investing in the munis. And so muni bonds are really only appropriate and are only priced for people that are in the highest tax brackets. Okay, any questions on the bond yield comparison? No? All right. So if I ask you a question, I have Joe Saver that's in the 20% tax bracket. Should he buy a corporate or a muni bond? What's your answer, or what's your gut instinct going to tell you right off the bat?
Corporate.
Yep, corporate. His tax bracket's really low. Very, very unlikely that a muni is going to be the right choice for him. Unless there's some unique circumstance, like he's phasing out for Medicare, if he has any more income recognized or something like that. But other than that, always the corporate. All right, and so here's the math for those of you that are going to duplicate this afterwards, but you should find that it's 3.02% on the corporate when you're in the 28% tax bracket and 2.94% when you're in the 30% tax bracket. All right, so let's shift gears a little bit and talk a little bit more about the equity side. So there's a few different types of equities. So the one that we're the most familiar with is common stock. So common stock is stock that's issued that gives you a residual claim on the company assets. And so what that means is the common stock only has value if a company liquidates after it has met every other obligation. So that means that first they have to pay out their bond debt, then they have to pay off their preferred stocks, and only if there's leftover money, then you would get some of the value for the common stock. So common stock is the most risky of the equity types of investments in terms of the seniority of debt, but that's also why common stock tends to give you the greatest long-term return. The beauty of common stock, though, is that even though you're investing in a company, you're limited in your liability, meaning that if the company has one of the worst lawsuits in history, the most that you can lose as a common stock shareholder is what you paid for that common stock. So they can't come after your personal assets. And so this is an attribute that makes common stocks extremely attractive for investments within a portfolio. So there are also a unique instrument called preferred stock. So preferred stock is kind of a hybrid, if you will, between bonds and common stock. And what I mean when I say that is that preferred stock actually has a stated rate of return or stated dividend rate, and it pays that dividend into perpetuity. Now, two of the things that make preferred stock different from a bond is one, companies have the ability to turn off and turn on the dividend that's paid to preferred stock. So for example, if the company starts going through a hard economic time, meaning they're not having the cash flow that they need, they can actually shut off their preferred stock so that they can maintain their solvency and liquidity needs. So the other difference is that preferred stock is actually inferior to bonds when it comes to being paid back. So for example, if the company went bankrupt, they'd pay off their debt first and then their preferred stock, and then finally the common stock shareholders would be subject to whatever's left over. Now, preferred stock can be a very attractive investment vehicle for corporations because it receives, or corporations can receive preferential tax treatment for investing in preferred stock. So you will commonly see preferred stock used as a vehicle for investing in another company because of the preferable tax treatment. So up to 85% of our preferred stock's income that's received can be sheltered from taxation because of the way that the tax code's written. The last instrument that I want to note here is what's called an American Depository Receipt, or an ADR. You've probably seen an ADR and didn't know that that's what it was. So if you've ever seen Alibaba or Toyota or any other type of foreign company listed on the US exchange, that's actually an ADR. What an ADR does is it takes foreign listed stocks, they put it in this basket, they adjust the basket for the currency exchange rates, and then the ticker shows up on the stock exchange. And so it's a vehicle that allows you to invest in foreign companies using US dollars. Without an ADR, what would be required is for you to take your dollars, convert them to the foreign currency, go into the foreign exchange and buy the stock in the foreign exchange. And so ADRs make the process much simpler in order to buy. So for example, if you ever bought a Canadian energy company, so a lot of the fracking are Canadian companies, you're investing in an ADR. And so the bank that puts this together charges a nominal fee in order to put this together, but it's extremely inexpensive. Now, one of the risk factors that an ADR has that's not subject to common stock is that ADRs then have inherent currency fluctuation risk. And so once again, the stock can go up in value, but if the currency fluctuations move against you, you can still lose money in an ADR, even though the company actually did quite well. Any questions on these three different types of equity instruments? No? All right, you guys are all going to ace the quiz, I can tell.
I had a question,
Yeah,
Jared.
sure.
I'm sorry, I didn't. I'm not sure.
So, Pete, is that your question that you typed in? Does every company have preferred stock? Is that you?
Yes, it is.
Okay. Yeah, so does every company have preferred stock? No. There are a lot of companies that don't have preferred stock. For example, I don't believe Google has preferred stock. I don't think that Apple does either. So preferred stock is not a requirement for companies to issue. It's an option that's available, but they may or may not issue it. And then does anyone have access to it? If it's a publicly traded company, then yes, everyone would have access to it because it's traded on the exchange. If it's a privately traded company, then no. Just like private stock isn't available to everyone. So it really depends. Any other questions, Pete, or does that answer what you're looking for?
That's good.
Okay, perfect. All right, and so since there's a lot of different assets, a lot of different investment vehicles that you can choose from, it would be extremely difficult to track them and to get a gauge of how the market's doing, if an asset class is doing well or doing poorly. And so because of that, indices have been established, which really give you a pulse on the movements in the market. And so there's two that are the most widely known or cited, which are the S&P 500 and then the Dow. Also point out the NASDAQ here in just a moment. But what these indices are doing is they're capturing the market movements of the securities that are included to let you know how the market generally did in that day. And so the Dow is a collection of 30 large, what are called quote unquote blue chip or high credit quality corporations that gives you a general pulse of the market. This is a price weighted index, meaning that the index is compiled using the stock price of that security. So for example, if I have stock A that has a stock price of $100 per share, and I have stock B which has a price of $10 per share, stock A is going to have 10 times the weight within that index, that price weighted index, because the stock price is 10 times larger than stock price B. So that's what is referred to as a price weighted index. Now you'll notice 30 companies isn't a lot. In fact, it's very, very small. And so let me throw out a question to you. Why do you think the Dow is so widely cited if it only tracks 30 companies? What are your thoughts?
It's the oldest index.
Yeah, you're exactly right. It is by far the longest index. It was established in 1896. It literally has over 100 years of history behind it. And so it's very well known, and you can do a lot of data extraction since it goes back a long way. Does anyone have a guess as to when the S&P 500 was created? What do you think? Or you can Google it real quick.
I think it was 1932.
So it's actually in the 1970s. I think it was 1979, but I could be off on that. I haven't looked it up in a while. But it was in the 70s. So think about how many years of history you have if you use the S&P 500 versus the Dow, right? You can't go back 100 years with the S&P 500. In fact, you can really only go back about 50, not even 50, 40 to be more precise. And so just there's not nearly as much data there. So because of that, I think that we're going to see the Dow cited for a long time. And it may be one of those things that's so ingrained in culture that we just continue to use it. But with the S&P 500, it has a couple of advantages over the Dow. One is that it's a much broader index. It follows 500 firms versus the Dow's 30, so it's almost 20 times larger than the Dow. But the other benefit, which is even more important, is that it's a true market value weighted index. So I mentioned earlier the Dow would give 10 times the presence within the index with the stock price that's $100 versus $10, which is a completely arbitrary figure. What I mean when I say that is that if I took stock A, which had a price of $100 per share, and I did a 10-for-1 stock split, that stock price would then drop to $10 per share, which would be exactly equal to stock B. Now, with all else equal, a price-weighted index would then give stock A and stock B an equal weight within the portfolio because the stock price is the same. And so all someone has to do to artificially increase or decrease their exposure within a price-weighted index is to do a stock split or a reverse stock split. So not a very good methodology. The S&P 500, however, uses a market value-weighted index, which means it takes the number of shares outstanding multiplied by the stock price, which then gives you the market cap, and then that's used to determine the weight within the S&P 500. So this is something that is not arbitrary, cannot be arbitrarily manipulated, and so as such is considered to be a far superior index methodology. So based on the two descriptions that I gave you with the Dow and the S&P 500, so based on the price-weighted and the market value-weighted index, what type of bias do you think is exhibited in the Dow? What type of company is going to have a far greater weight within the Dow?
the top like 5 companies or so.
So not just the top 5 companies, but the top 5 companies, especially that didn't stock split. Right, so your companies that keep that stock price really high are going to be the most heavily weighted. So for example, think about Amazon. Amazon's stock price is $1,500 per share, right? Not as big as Apple, but Apple's stock price is $175 or $180 per share, right? So the Dow, without other adjustments, is going to give Amazon a much bigger weight, even though Apple is truly the larger company. So large stock price companies have a clear bias within the Dow. What type of company has a bigger weighting or is biased within the S&P 500?
Bigger market cap.
I'm sorry, can you say that again?
The one with the bigger market cap.
Yeah, absolutely. Your large companies move the S&P. So I haven't seen it as much recently, but it used to be for the longest time that people would explain the movement in the S&P 500 by noting what ExxonMobil and Apple did, because they were by far the biggest companies. What that was recognizing is that as goes Apple, because it carried so much weight within the index really moved in that direction also. And so big companies really sway the S&P 500. In fact, the top 50 companies really determine what the S&P 500 is going to do for the day. The remaining 450 companies are so small, they really don't have much significant impact at all. So given the 2 methodologies, and I stated this earlier, between the Dow being price weighted and the S&P 500 being market value weighted, which one is superior? So if you were to create your own index, which methodology would you want to use? Price weighted or market value weighted?
Market value weighted.
Yeah, market value weighted all the way. And if you really wanted to get fancy, you could do what's called a free float market value weighted index, which means that you only consider the market value of what's publicly available for trading. So for example, if you have restricted shares or restricted stock, you remove that from the market value, and you only allow the publicly traded portion of the company to count as weight. Once again, that's a free float market value weighted, which is the gold standard when it comes to index methodology. But market value weighted is always going to be a better representation between the 2 methodology choices. Great. Any questions on the difference between the Dow and the S&P?
Hey, Jerry, how are these indexes chosen? So, for example, like the Dow Jones, is it the 30 stocks with the 30 highest prices, or is it does it change every quarter? How do they do that?
Yeah, so it's not necessarily the 30 largest companies. The Dow Jones or the Dow Jones Industrial Average, which the name says industrial, but not every company is an industrial, or at least the way that we define industrial today, is comprised by Dow, right? Dow Jones, and so that's where the name comes from. So they choose the 30 companies that are going to be held within that index. I don't know exactly how they decide. It's not based on size, because there have been very large companies that were excluded from the index for a while. Like Apple wasn't included in the Dow for a long time, even though they were massive. But the Dow will announce when a company is going to be dropped and when a company is going to be added. And so it's a pretty big deal when a company is dropped or added to the Dow. So perfect, Cynthia. I'm glad you're able to join us. So I think hopefully everything looks okay.
Hi, Jerry.
Hi.
Oh, it sounds like you get a lot of feedback when somebody talks.
Oh, okay.
Is that an issue for you?
So I'm not getting.
Yeah, I can't hear. That's the question.
Okay, so you can't hear when people ask questions. Is that what I heard?
Yeah, I think that was Eric.
Yeah, so Cindy, how do I fix that?
Say that again, Jeremy. I couldn't hear you.
I was asking, how do I fix the feedback issue then? muted to start off with, but then when people speak and unmute themselves, it seems like it's the initial start of someone's comment that's creating the feedback issue.
Yeah, and I don't know if right now you're muted and I'm talking, but I don't know if people are getting feedback now.
Yeah, I've been muting myself every time someone else speaks to try to prevent it, but it's not an automatic process. I wonder if there's a way that I can call in and that might clear things up. That's what I did on the old system to help eliminate feedback.
Yeah, and that might be it. I'll do a little research for you for the next class, if that's okay, and find out.
Yeah, okay. Yeah, because unfortunately there's not a way to have the system automatically mute your mic if someone else starts speaking. I'm just doing it manually, which seems to be working, but obviously if I miss something or someone, it's not going to work. But other than that, everything look okay on your side?
Yeah, okay, I got it now. Everything looks okay for me. You know, I just did my class. I didn't get the feedback like you're getting, but I don't know why that is, so I'll do a little research. And then students were able to raise their hand, do all those things. Are your students running into any other problems while they're in the class this evening?
You know, let's go ahead and do a little test real quick. Can everyone see if you have access to raise your hand? I don't see that actually listed as an option on my side. I don't know that you do. Oh, no. Okay, you can. Yeah,
so here's how the students have access to raise their hand, is that they click on participants, and then there's the option there for them to raise their hand. Jeremy, you don't see that the way that the students see it.
Yeah, okay. And you know, I just accidentally minimized the participant list. I need to find a way to get that back. That's the one thing I did notice, is that it's hard to get the chat and the participant list up when you're doing your slides. I had a difficult time actually getting that to show temporarily.
Now, do you have a small bar at the top that gives you some options?
Yeah, so actually I see that it has my participant list, but it doesn't have an option to see the chat. Actually, there's a chat. Okay, so that's how you access everything.
Right.
Okay. All right, perfect. Well, thanks, Cindy. If you don't mind sticking on just for a little bit in case there's anything else, but I think that's good. And so sorry.
All right, I'll stick on.
Okay, perfect. Sorry for the interruption, everyone. So let's go ahead and continue then. So we're going to look at the way that a price-weighted and evaluated calculation actually works. This will really help to bring home the different biases that are exhibited in each. And so once again, with the price-weighted, since it's based on the stock price, theoretically, if you wanted to increase your exposure in an index, all you'd have to do is a reverse stock split, or make sure that you never split your stock, because then your stock price is going to be really high, which is going to give you a much greater representation within a price-weighted index. The value-weighted index, though, however, if you want to increase your representation within the index, you have to do it the hard way, which is to actually grow the company. And so the value-weighted index really doesn't have any means of being manipulated, because your company is going to be represented by simply the success or the lack of success that's achieved. And so with that in mind, let's go ahead and look at a 4-stock index. We're going to look at the difference between the price-weighted index methodology and then also the value-weighted index methodology. What you'll find with the value-weighted index methodology, by the way, is that there's often a divisor that's used in order to make the number more manageable. So for example, the S&P 500 has a pretty large divisor so that the numbers of the S&P 500 are 2,000 or whatever the number may be. Because quoting something as being at 238,420 would be very difficult, and it would probably limit the use of that index. So by having more manageable numbers to work with makes it easier for the investing public to reference your index. So for this practice problem, we have 4 different stocks. So we have stock A that has a price of $25 per share, and there's 1,000 shares outstanding. Stock B that has a stock price of $50 per share with 200 shares outstanding. Stock C 100 with 50 shares outstanding, and then lastly stock E at $35 per share with 5,000 shares outstanding. So given the price-weighted index methodology, what is the price-weighted index value? So you're going to take the stock price divided by 4. So what is the price-weighted index value with these 4 stocks?
$52.50.
Exactly, yeah, $52.50. So was that, I didn't see who that was speaking. Was that you, Josh?
Andrew.
Or Andrew? Okay, Andrew, would you mind just walking through really quickly how you came up with that answer?
Yeah, we added up all stock prices.
Okay, so 25 plus 50 plus 100 plus 35, so 75, 105, 205, and then divide that by 4, which gave you 52.50. Perfect.
Yeah, sum of all of them was 210 divided by 4 is 52.50.
Awesome. And then looking at the stock A through D selection, which stock is going to have the biggest weight within the price-weighted index?
Stock C.
Right, absolutely, stock C, biggest stock price. Okay, now let's do the same thing but using a evaluated methodology. And so for the evaluated methodology, remember that it's the market share that matters, not the price per share. So the way that you come up with the market share or the market cap is that you take the stock price times the number of shares outstanding. So for example, for stock A has a market cap or market share value of 25,000. I calculate that by taking 25 times 1,000, which equals 25,000. Then I'll simply sum up all the market caps of my 4 positions and then divide by my arbitrary divisor of 10,000, which is listed. It'll always be given. So given that construction methodology, what is my value-weighted index of stock A through stock B?
20.6.
Sorry, so 20.6, did I hear?
21.5.
All right, so 21.5, I didn't see whose name that was that just spoke, but how did you come up with 21.5? Do you mind walking us through the numbers real quick? Oh, did that come through? Who was the person that listed the answers 21.5?
Oh, that was me. I think I'm having phone issues here, though.
You're coming through. The problem is, Eric, unless I'm scrolled to your name on the list, I can't see who's the one speaking. But Eric, how did you come up with 21.5?
So again, just finding the market capitalization of each stock. So 25 times 1,000 plus 50 times 200 plus 100 times 50 plus 35 times 5,000. And then summing all of those up and then dividing it by 10,000.
Okay, perfect. And so that gave you 21.5. Given the 4 stocks with the evaluated methodology, which stock has the biggest weighting?
Stock D.
Stock D. Yeah.
Okay, there's a little bit of stock D, right?
Correct.
Yeah, and so stock D, because it has by far the largest market cap. And so you'll see very clearly that you'll see different biases exhibited given the construction methodology. So this is important to recognize because, for example, the Dow oftentimes will track differently than the S&P 500. And this is a large part of the reason is because they're using very different index construction methodologies. If you're curious why the Dow is using a price-weighted index, why didn't they use something more superior like a value-weighted index? Think about what type of technology was available in 1896, or the lack of technology. And they certainly didn't have computers, and they didn't have things like a calculator in order to do the math required for a value-weighted index. So the price-weighted methodology was something that was available, relatively easy to execute, and it's stuck around today.
Jeremy, your mic is muted.
Can you hear me now?
Yep.
Yep.
I was using the space bar to unmute, but then it turned it into changing slides. So I guess I'll just use the other way. Thanks for letting me know. So the last asset class that we're going to go through is on the capital market side are derivatives. And so with derivatives, remember that they derive their value from other assets. It's where the name comes from. And it's not just stocks that they derive their value from. Derivatives can actually get their value from bonds. They can get their value from indices. So for example, there is an index, or excuse me, a derivative on the S&P 500 index. They can get their value from commodities. So in other words, if it's something that you can place value on, there's probably a derivative out there for it. There are even derivatives for the interest rates that are available in your fixed income market. So the most common examples that you'll see cited when we look at derivatives are calls and puts and futures contracts. But just note that this is not by any means a complete list when we're talking about them. So we're going to really dive deep into options specifically in a later week. But just note that with a call option, you're buying the right to buy an underlying asset at a certain exercise price, and you're participating in the upside of the asset with the call option. The put option is where you're gaining access to the downside movements of the stock. So it differs a little bit from the call option in that the put drives value when the asset drops in stock price, whereas the call option gains value as the stock goes up in value. A future contract, however, is like combining a call and a put, where the future contract actually fluctuates in value if the stock goes up or down. And so it participates in movements either way. A future contract, much like an option's leveraged, meaning that its value moves more rapidly than the underlying asset that it's linked to. In other words, what the underlying security is. And the future option, the future contract rather, much like the call and puts, actually has a specified maturity date. So when you buy most derivatives, they actually have specified maturity dates that don't last into perpetuity. And so the same is true for a future contract. Now, anytime you buy a derivative, you're either going to be long or short the position. When you're long a derivative position, it means that you're the one taking delivery at whatever that security does, that derivative instrument does at maturity. So for example, if I'm long a call option, that means that I'm buying the right to the future upside of that underlying security. And whatever that future upside is at or within that maturity window is, I, as the person that's long that maturity, or that instrument rather, am entitled to that benefit. If you're short a derivative asset, however, that means that you're the one obligated to give whatever that instrument entails. So for example, on that previous example where I'm long a call option and I'm entitled to that benefit, whoever is short that option is then required to give that benefit or to pay that benefit to the person that was long the asset. So with every derivative contract, there is someone that's long and someone that's short. Someone that buys the whatever the benefit entails and someone that's on the hook and is paid for meeting the obligation that that derivative instrument entails. So once again, we're going to dive much deeper into this in a future week, but it's important that you have a general understanding of what a derivative is and how it drives its value. Any questions on derivative assets before we move on? No. Okay. All right, so we're going to shift gears a little bit, and we're going to talk a lot about interest rates. So given what's happening with our interest rate market within the U.S., it's actually something that's received a lot of attention as of late. And so we're going to talk about why interest rates are such an important thing to focus on and to pay attention to when it comes to portfolio construction and making investment choices. So really quickly, though, it's important that we understand how interest rates are set. So with the exception of short-term interest rates, which are set by the Fed, the intermediate and longer term interest rates are actually set by market forces. And so they're set by the equilibrium point between supply and demand. And your supply is set by the market and is set by the government. And your demand is also set by your market participants and the government. And so the government certainly has influence on what happens to interest rates. So for example, think of things like quantitative easing, where the government pumped a lot of cash into the marketplace by buying bonds. But the market can act independent of what the federal government does because it is set by supply and demand. So that's why you'll often notice that there may be a disconnect between what the Fed does and what the interest rate market does. So for example, the Fed has been raising rates for about the last 2 years, and you'll notice that the intermediate and long-term rates really haven't budged much. So the short-term rates have risen much faster than what the intermediate and long-term rates have. And the reason for that is because even though the short-term rates have been increased by the government, there really hasn't been much of a change in the supply and demand curve for interest rates, which is why they have remained relatively intact. And until just recently, the 10-year really had a hard time budging much above 2.5%. And so when we look at interest rates, the way that we generally talk about them is in terms of a nominal interest rate. So what a nominal interest rate is simply the simple return that an asset gives you. So for example, if I talk about buying a CD and I say that the CD is giving me 2%, that means that if I take that value that I'm investing or that I'm putting into the bank, I'm going to multiply 2% on an annual or whatever the CD payment structure is, and that gives me my interest rate. However, that is not the full story when it comes to interest rates. It's also important to recognize that inflation is in effect reducing the amount of interest that I earn over time in purchasing power terms. So purchasing power terms means that I take into consideration what inflation's doing. So for example, if I buy a CD that pays me 2% per year, and I recognize that inflation's also 2% per year, by buying that CD, I am not increasing my purchasing power. I am merely leaving or keeping my purchasing power intact. And so I can restate my interest rate in real terms to understand how much my wealth or my purchasing power is increasing over time. And the way that you do that is by using one of the two formulas listed below. So these formulas calculate the exact same thing. I list it both ways since it's likely that you've seen one of the two versions in a previous class. But just know you can use either one of them. And if you're really comfortable with algebra, you could actually convert one to the other by just using the rules of algebra to restate the formula. But the way that you calculate the real rate of return is by taking the nominal rate, subtracting that from that the inflationary rate, and then dividing that by 1 plus the inflation rate. Or alternatively, you could take 1 plus the nominal rate divided by 1 plus the inflation rate minus 1. So either one of those, once again, will give you the exact same answer. Now, you may be tempted to calculate the real rate of return by simply taking the nominal rate minus inflation. So for example, if my nominal rate's 3% and inflation's 2%, I might say that my real rate is 1%. Just note that that is close, but it's not exact. And so for the purpose of this class, make sure that if you get a problem on it, that you actually take the time to calculate it the real way. Because if you do the shorthand way, which is a linear approximation, you're actually going to get the wrong answer. So don't fall victim to doing it the shortcut way. You want to make sure to use the real formula, and especially for the CFP. On the CFP exam, if you end up taking it, you need to calculate it this way. They will have this answer listed on the exam, and this answer will be wrong. So it's important for this class and for the CFP exam that you do it using one of these two formulas. So let's make sure that we're all comfortable with this formula. We're going to go through a practice problem. So let's say that we have the opportunity to earn a nominal yield of 12%, or the institution that we're investing in says that they'll also give us the alternative of a real yield of 4.75%. And let's say that our estimation is that inflation is going to average 7% per year. So I know not something that's real in today's environment. Let's say for whatever reason, inflation started heating up and we're given these two options. Which one would you choose? Is it better to have the 12% nominal rate or the 4.75% real rate of return?
The real yield of 4.75.
Okay, perfect. Why the real yield? What did you get when you converted your nominal rate in real terms?
4.67. $4.67.
Oh, there we go. Sorry, I thought I had unmuted myself. So that's perfect. So 4.67, obviously less than 4.75. So that's the more attractive vehicle. You'll notice, and the reason why I set up this practice problem this way is that if you would have tried to take the shortcut way, 12 minus 7 is 5%. That's bigger than the real rate. So I'm going to go that. You would have chosen the wrong answer. And so when you do that, when you calculate the more precise way, you're going to actually get a different answer at times based on the inputs that you have. So, and then for those that are following along, the way that we calculated that is we took 12% minus 7% divided by 1.07, or 1 plus the inflationary rate, which gives us the 4.67. Or alternatively, we could have taken 1 plus 12%, so 1.12 divided by 1.07 minus 1, once again gives us 4.67. Any questions on this practice problem before we move on? No. Okay. And so for those following along, here's the math for you. Make sure that you're comfortable and able to calculate this. Right, and then when looking at interest rates, it's also important that we recognize that we can state things in simple terms, or we can state things taking into account compounding. And what's really confusing about the marketplace is it will often switch between the two and not differentiate. And so when we're really trying to be accurate and we want to account for compounding, we will use the effective annual rate of return. So once again, the EAR, or the effective annual rate of return, accounts for compounding. However, when you see the APR listed, you will notice that that does not take into account compounding. And so since compounding actually increases the rate of return, since it's calculated over a greater number of periods, it's very common for banks and lenders to state the interest rate that they're going to charge you in APR terms, because it makes the interest rate that you're going to pay look smaller. However, when they're stating how much interest you're going to receive, it's very common for them to list it in EAR, or effective annual returns, because it makes the number look bigger. Now there's been some regulation to try to combat this, because most people don't know the difference. But it's important to note that once again, the EAR takes into account compounding, and it shows you the true effective rate of return, whereas APR does not. And so when you're given the APR, it's a good idea to actually convert that to the EAR so you can see the rate of interest that you're actually paying or receiving. So once again, based on how these are put together, if you are a lender, right, so you're lending someone money and you want it to make look like you're charging them the lowest interest rate possible, are you going to use EAR or APR? Right, APR. Because it doesn't show the compound interest exactly. Any questions on the difference between the two? All right. And so when calculating the returns of assets, there's a few different ways that we can do it. The most simplistic way is to actually calculate what's called a holding period return. All a holding period return does is it looks at what the asset was purchased for, any cash flow that was generated until it was sold, what the selling price is, and then divides that by the initial purchasing price. So once again, it's the selling price minus the purchase price plus any cash flow received along the way divided by the purchase price. And that gives us the holding period return, or in other words, the return that I generated over the time that I held that asset. So we're going to walk through a practice problem. So we have a stock that we held for 5 years. We purchased it for $73.27, and we then sold it after 5 years for $91.38. And this particular stock paid a semi-annual dividend of $2.50, or in other words, $5 per year. What is the holding period return for this stock? So what is my 5-year total return?
%58.8%.
All right, perfect. So we'll just round up and call it an even 59%. Right, so the way that we get that is we take the the selling price, 91.38, minus 73.27, plus 25, which were the dividends paid along the way, and then divide that by my initial purchase price of 73.27. Right, so I have a 59% rate of return over that 5-year period. Let's say I had another asset that I did the same thing with, and I generated a 70% return. Can I compare my 59% 5-year rate of return to my 70% 10-year rate of return? Yay or nay?
Yeah, you can just annualize it.
Okay. All right. So you can annualize it. So by doing that, you'd be able to see that the stock I held for 5 years is a superior return than what I earned on my second stock that only did about 11% more over a 10-year period. But what are some of the pitfalls that I'd run into by doing this? What do you think, Jennifer? What are some of the limitations that I would run into by trying to compare these two different assets like that?
Well, the prices are going to be quite different in a 10-year period.
All right, so that's fair. So if one was a very large investment, one was a small investment, all right, it may not be fair to compare the two directly. What else might be an issue? What about risk?
You may not be comparing equal parts of the business cycle. So, comparing an investment, during equal time periods, given equal market conditions, would be a more fair assessment.
Yeah, absolutely. And that's not the most intuitive of things to pull out. So I'm glad you mentioned that. So if we compare a stock in 2017, for example, and then we compare that same stock in a year like 2015, you're going to notice almost all assets did very well in 2017 because of how well the market performed. Where in 2015, most assets did quite poorly. And it may not be a reflection of that individual stock per se, but it might be a reflection of the business cycle or the market environment that it was in. That's absolutely true. And the same is also true when you try to annualize returns and compare them to. Because if you're annualizing returns in a favorable market environment and then comparing that to returns of a security in an unfavorable market environment, it might make your riskier, less performing security look better simply because it was in a better time. And then the last pitfall that I want to note is even if we're looking at assets over the same period of time, if they have different risk characteristics, you may only get 80% of the return in one asset, but if it only has half the risk, then that's a superior return because you're getting more return per investment dollar of risk. And so when we look at returns, it's important that we also note what the return, or excuse me, what the risk is that's inherent in that security. So it's for these reasons that in the real world, meaning as you do portfolio management, holding period returns are very rarely, if ever, used. But it's important that you know how to calculate it. But there are a lot of limitations to trying to chalk something up to just its holding period return, which can lead to bad decisions if not addressed properly. So this is the solution on how we came up with 59%. And so because of the limitations of looking at the return, it's important that we then balance risk with return so that we can make better or more effective investment decisions. And so we're going to go through some of the ways that we are able to balance risk with return, and then looking at the superior return or the superior returning assets once adjusted for risk. And so in order to do this, then it's important that we develop some tools to come up with some of the statistics that we're going to need. So one of the things that we will often run into in a portfolio is it's very rare that you have one asset within a portfolio, but you'll typically have 2, 5, 20, 100 assets within the portfolio. And so in order to come up with a return characteristic, you want to calculate what's called a weighted probability or a weighted return of your portfolio. The way that this is done is actually very straightforward. What you do is you take the percentage of that asset, or you can even say the percentage likelihood of a case of that asset, and then you simply take the product of each of the different cases and then sum the different cases to get your overall return. So in this example, you see we have one asset that has 4 different outcome scenarios. We could also do the same process with a portfolio of 4 different assets with different weights. The math and the methodology is exactly the same. So in this case, we're going to look at a stock that has 4 different expectations. So we're going to say that we're expecting either a bear market, a neutral market, a bull market, or a strong bull market. Given a bear market expectation, which we're going to get a 20% likelihood of happening, we'll say that this particular security loses 5%. In a neutral market scenario or a flat market, which is 30% likely, we're going to say that this asset generates a 5% rate of return. In a bull market, which has a 25% likelihood, we'll say that this asset has a 10% return expectation. And then lastly, in a strong bull market, which we're going to assign with the 20% likelihood, our security gives us a 15% rate of return. So what is the weighted sum of these different expectations? So in other words, what is negative 5% times 20% plus 5% times 20%? So on and so forth as we sum through the different expectations. What is the product of these 4 different, or I should say the sum of the product of these 4 different expectations?
8.25.
Okay, so I have 2 different answers. I see one says 5.75 and one says 8.25. So have one other person give an answer, and then we'll talk about why that's the right answer. I believe the answer is 5.75. Let me do the math one more time just to make sure.
Oh, right. I didn't go negative on expectation 1.
Okay, yeah, that's what I was going to guess was the mistake. So the answer is 5.75. The way that we came up with that, once again, is negative 5%. So that part's key. If you forget to enter your negative, you're going to come up with a bigger number. But negative 5% times 25 plus, and then you're going to want to open parentheses so that your calculator does it correctly. 0.05 times 0.3, close parentheses, plus, open parentheses, 0.1 times 0.25, close parentheses, plus, open parentheses, 0.15 times 0.2, close parentheses, equals. And when you do that, you will get 5.75. Right, so our expected return, given these 4 different states, is 5.75%. Or alternatively, if this was a 4-asset portfolio where each of these different probabilities showed us the weighting within the portfolio, that would also give us the 5.75% expected return. And so we can calculate the expected return even when we have a blend of assets. The nice thing is that it's very simple, very straightforward to calculate expected return. And so it's a very clean, straightforward process to come up with. Does anyone have any questions on how we came up with the expected return given these 4 expectations of 5.75%? No? Okay. So we also can calculate the risk within a portfolio given different states or given a different number of assets. Now, unfortunately, calculating the risk within a portfolio is not nearly as straightforward as calculating the return. And the reason for this is that when you have a combination of different states or outcomes or a different combination of assets, risk not only needs to measure how much individual variation there is within the different states or within the different assets, but also you have to measure how much of the risk is offset by the movement within the different assets. So for example, if one asset zigs and another asset zags at the exact same amount but in opposite directions, the risk then is 0 because they cancel each other out. And so when you calculate variance or standard deviation, you have to be able to account for that. And so because of that, you'll notice that the formula to calculate the standard deviation of a 2-asset portfolio, or the variance of a 2-asset portfolio, takes a lot more work. And if you're a little bit rusty, just remember the standard deviation is equal to the square root of the variance. So the way that you convert between the two, take the square root of the variance and you have standard deviation, take the square of standard deviation and you have your variance. And so the way that we calculate the variance of a portfolio with different assets and different expectations is we simply take the expected return, right, which we calculated on the previous slide, 5.75%. Excuse me, let me back up. We take the stated return of the expectation minus the expected return, which we calculated on the previous slide of 5.75%, square the result, and then multiply that by the probability of that different expectation. For the sake of time, we're going to skip ahead and look at the answer, but make sure that you know how to do this on your own. This is one of those concepts where it looks easy until you try to work it yourself, and that's where you'll run into the bugs. So you want to make sure that you work this through a couple of times so that way you can figure out the areas that you trip up on and make sure that you're able to work past it. So once again, I have the return given the different case, the different expectations listed here, the probability listed here, the expected return that we did on that first slide is listed here. So the first step is to take the expected return minus, or I should say the expectation return rather, minus the expected return, right? So that's the answer listed here. So negative 5% minus 5.75 is equal to negative 10.75. 5 minus 5.75 is equal to negative 0.75. 10 minus 5.75 is equal to 4.25, and so forth. Then we're supposed to square that result. So this percentage here squared is the figure that you have here. And then the last step was to take the probability and multiply that by the squared difference between the expectation return and the expected return. So 0.25 times 0.0115565 is equal to 0.002889063. 0.3 times 0.0005625 is equal to 0.000016875. So on and so forth. We do that for all four of the expectations. Once we get that figure, or all four of those figures rather, we add them, which gives us 0.00506875. Now this is not the answer. Once again, remember that this is the variance. The temptation is to say, oh, my standard deviation must be 5.1%. That is not the right answer. So you need to take the square root of the variance in order to then calculate the standard deviation. So once we take the square root of 0.00506875, we get 7.12%. So the standard deviation, or the risk of this portfolio, is 7.12%. Any questions on the risk calculation that we just did? No? All right. Hopefully the memory of this calculation is flooding back from your earlier classes. All right, so now that we know how to calculate the risk and we know how to calculate the return, we can actually start doing more advanced calculations, which looks at the number of units of return we're getting per unit of risk. So one of the most often used and one of the more useful tools that we'll use to look at the amount of return we get per unit of risk, also known as reward to volatility ratios, is the Sharpe ratio. All the Sharpe ratio does is it looks at the risk premium and divides that by the standard deviation. So for example, on our example that we just went through, we saw that we had an expected return of 5.75, standard deviation of 7.12, and we're going to say that the risk-free rate right now is 2.5%. So the Sharpe ratio requires us to use the risk premium. What the risk premium means is it looks at the return in excess the risk-free rate. So 5.75 minus 2.5%. Divide that by 7.12% and we get the Sharpe ratio of this asset. So who can tell me what the Sharpe ratio is? See if we can get someone new. What do you think, Pete? What are you getting as our Sharpe ratio?
Give me 1 second. 4.56%.
All right. 4.56. Did anyone else get a different answer? So, and you shouldn't have, because that's exactly right. So you get 4.565 units of return per unit of risk. All right, perfect. So the way that we got that, once again, is we took 5.75% minus 2.5% divided by 7.12%, which gives us 4.565. Now this is very useful because now we can actually compare this result to other assets reward to variability figures to see which asset's superior. So if I did the same exercise and I came up with an asset that had a Sharpe ratio of 0.7, right, arguably the asset with the Sharpe ratio of 0.7 is superior because I'm getting more units of return per unit of risk. Now, when we have standard deviation, it's not necessarily the most intuitive on what this 7.12% means. And so when we talk about risk, it's important that we understand what it is that we're referring to. When we talk about stocks, almost always we assume what's called a normal distribution, or we assume normality. What normality means is that we're assuming that the asset that's being looked at, or the pool of assets that we're considering, exhibits a normal distribution curve. When a combination of assets or an individual asset exhibits a normal distribution curve, it allows us to calculate very advanced portfolio metrics with much more succinct math, and gives us a way to really capture what the inherent risk is in a portfolio in a relatively straightforward manner. If you're a little bit rusty on what normality means and how a normal distribution curve, what you'll recall is that what a normal distribution curve recognizes is that one standard deviation occurs 68% of the time. Now the shortcut is to say that it occurs 1/3 of the time, so about, or excuse me, 2/3 of the time rather, so about 66% of the time, but to be more precise, 68% of the time. So if we said that the last asset that we're looking at was normally distributed, that would mean that approximately 66% of the time, that security would move within plus or minus 7.12% of its expected return, which was 5.75%, right? 95% of the time, the asset's going to move within 2 standard deviations of its mean. So 95% of the time, that stock would move within 2 times 7.12%, or 14.2% of its mean. And then 99% of the time, the asset will trade or will move within 99% of its standard deviation. So 3 times that 7.12%, or a little over 21%, added to or subtracted from its mean. So to make sure that we're all comfortable with the normal distribution curve, we're going to go through a practice problem just to make sure that we can all do it. So we're going to take that stock, that 5.75% return, the standard deviation of 7.12%, and we're going to calculate what the expected return is 95% of the time. So once again, remember, 95% of the time is within 2 standard deviations. So what is my return 95% of the time with this security? Right, so we're going to simply take the mean, right, 5.75%, plus or minus 2, because it's 2 standard deviations of 7.12%. Right, so I have on the high end 5.75% plus 14.24, right? That's my upper. On the low side, I have 5.75% minus 14.24. So what is the range of my security 95% of the time?
Negative 8.49 to 19.99.
Yeah, perfect. So I'm going to round it a little bit. So negative 8.5 to, so I think it's 20%, right? Sorry, no, that's not what's wrong. So 95% of the time, the security is going to have a return that's somewhere between negative 8.5% and 20%, positive 20%. That's why it's so powerful to know what the standard deviation of a security is, because when you know the standard deviation, you can actually calculate a reasonable assurance as to what the range of the security is going to be. So once again, what we did is we looked at this part of the normality curve, right? So within all of this, the security is going to range from between 8.5% to 20%. So you notice that there's very little that we did not calculate in these tails here, but that represents less than 4.5%, or I should say just over 4.5% of the distribution curve. In other words, these are very unlikely events to occur. So we are reasonably assured that the security is going to be plus, or it's going to be within 8.5% here to the negative, to 20% here on the positive, with the overall average expected to be about 5.75%. Right, any questions on how we use the normal distribution curve to come up with the range of the security's price movement, or return movement, I should say, rather? No? Okay. All right, well, that's everything that I have for you tonight. So thank you for bearing with me a little bit. We went a little bit long since we did the troubleshooting with Cindy. But if you do have any questions that pop up, make sure to reach out to me. You can either call me via phone, so it's listed on the syllabus, or you can email me and I will make sure to get back to you right away. But just as a reminder, you do have a quiz this week that's going to cover these topics. And hopefully, if you haven't already, make sure to print that out, have it in front of you, and you have until Sunday by midnight to get that accomplished. So please take all the time that you need on that. So with that, everyone, have a great night, and I will talk to you again at the latest on Monday.
Hey, Jeremy, I had one more question, if that's okay.
Yeah, absolutely.
I was looking through the discussion board real quick, and I just noticed that, did you want the initial response to be 600 words and the replies to be 300 words each? Is that?
Yeah, so I don't go through and I don't word count them, but really what that's intended to be is to give you an idea as to how much depth you should cover in there. So 300 words is generally about a paragraph or two. 600 words is 3 or 4 paragraphs. So that's the level of engagement that I'm hoping for on the discussion board. So use that to base your initial thread and then also your responses to one another. But if you're, say, 250 words on a response or 450 words, and that's not really what I'm after. Just trying to make sure that it's an engaging and lively discussion.
Understood. That's what I assumed. I just sometimes you don't want to take that for granted.
No, absolutely. I appreciate the question. All right, any other questions before we end for the night? No? All right, everyone, well, thank you so much for all of your participation. I really appreciate it, and I will look for your questions or comments and your posts on the discussion board, and if we don't connect before then, I will see you all again on Monday at 6 o'clock.
Thank you, Jeremy.
Thank you.
Thanks.
All right. Good night. Thanks.
All right, good night.
Good night, Jeremy. Good class.